Most traders make the mistake of chasing the market. Smart money does the opposite. Take a look at this chart. First, price creates sell-side liquidity, where many retail traders place their stop losses below the lows. Smart money sweeps that liquidity, triggering those stops and collecting the orders they need. After that sweep, the market forms a break of market structure, or BMS. This is the first clue that buyers are taking control and the trend could be changing. Next, price leaves behind a fair value gap, also known as an FVG. Instead of buying immediately, professional traders often wait for price to retrace back into this imbalance. Notice how price returns into the FVG and order block. This area acts as a high-probability entry zone where institutions often re-enter the market. Once buyers step in, price starts moving higher, breaks the previous highs, and eventually takes buy-side liquidity, where buy-stop orders are sitting above the highs. The key lesson is simple. Don't chase breakouts. Wait for the liquidity sweep, confirm the market structure shift, and enter on the retracement into the fair value gap or order block. This gives you a better risk-to-reward ratio and helps you trade with smart money instead of against it. Follow for more trading education and smart money concepts.